All right, welcome to today's video, everyone. We're going to cover both the manufacturing and the services PMI. Today is Monday, July 6th, so we just got the services today. I sent out a newsletter covering the entire thing, so I'll try to keep it pretty similar in this video. And if you've been following me for a while, you understand that I get roughly 80% of all my trade ideas from the PMI indexes. I'm not talking about deep value or contrarian value investing, but rather short to medium term, the swing trades in the industries that are showing expansion or outlier signals, such as the ones that we'll spot today. Speaking of which, this is the rotation confirmation that we just got from the PMIs. If you've been reading the morning digest out of the Offside newsletter, then you understand there's sort of two trades going on right now. One is the concentration into AI and tech, and some days we get a rotation back into real economy names, right? Like software, like building materials, like consumer cyclicals, and all of that. So that back and forth, I think, is the sort of uncertainty that the market is trying to price in, figuring out how and where AI will have its effects. Now, on the backdrop, both the PMIs are expanding still, albeit at a slower pace. Some data suggests that if you strip out the AI and technology trade out of both PMIs, the real economy is sort of anemic, right? We have a sort of recession and slowdown still happening since 2022 in the real economy. Even though a handful of industries are quietly breaking out because of the AI capex effects, right? So if you build out the entire AI infrastructure, industries like construction, primary metals, and others that we'll cover today, I keep benefiting from all this. On the other side, you have things like real estate, you have things like consumer cyclicals not doing so well. And we do have a signal out of both PMIs today, both in new orders, production, and inventory data. If we isolate those, we have industries with real breakout momentum into expansion readings. Now, here's what I like to see. If you have 3 consecutive months of expansion, then what happens next? The odds of an EPS increase, an earnings increase for the next quarter go up, right? So that's the sort of industry that I like to pick and then do my digging throughout for stock selection. So we'll get into that in a minute. Now, the convergence here is happening between manufacturing and services as they now agree on the same theme, that being primary metals, as I mentioned with the AI build out, apparel and retail, sort of the cyclical recovery that we're seeing, machinery, of course, tied to the AI build out, and then transportation and financials. That's a more specific theme that we'll cover later in this presentation as well. There are some trade signals as well that I'll cover here and deeper in the newsletter. So we have On Holding, which is ONON, Lululemon, LULU. Part of the apparel trade signal, we have Robinhood as part of the financials. KNX, which is Knight Swift Transportation, we have it as the transportation and warehousing. And then metals, we have a long short equity trade here, and then a warning for Micron and the memory trade. So that being said, let's get into it all. For the first time since this survey has been run in the AI build out, 53%, so the majority of surveyors see that the rotation that I just talked about is going to happen, right? So 53% believe that AI and memory trades are going to underperform and that they should be buying more of the real economy trades. This is where you see real economy services companies like the software enterprise. We have Adobe, Uber, and Workday. They're both, or all three of them, they're bouncing off the lows. So we have 8% in Adobe off the lows, 5% in Uber, and then 15% in Workday. So they're sort of going into a correction now, a correction to the upside. And what follows that is a bull market, a renewed bull market. And I think that if this rotation keeps going on as far as getting away from the AI and tech trade back into the real economy, you may see more of this price action go on. And in fact, 53%, the majority of these surveyors see that happening. So let's look at GDP impacts on or from the PMIs, right? So 15 to 20% of GDP is represented by manufacturing. So it's not that big a signal, but it is a very strong signal when it comes to cyclical names, some part of employment and cyclicality for the consumer. right? So in services, you have the opposite. This is where 80% of the economy is. The US is a services based economy. And if you watch the Korean crisis video, then you understand that within that 80%, most of it is software. So to believe that AI is going to kill software, well, you have to believe that AI is going to replace 80% of the US economy. I just don't see that happening. And again, this is where 80% of our trade ideas come from, both of the PMIs. Let's start with manufacturing, right? So it is still expanding, like I said, but at a falling pace. So right now it's at 53.3. Markets really don't care about anything below 53 because from 50, which is the middle line, right? The cutoff line between expansion, neutral, and contraction, anything closer to 50 really says nothing about the market and the economy, right? So 53.3 is still an expansion, but the market could stop caring about these signals because we're getting close to a neutral territory. But if you look at the previous trend, we are coming from 55 in December, now at 53.3. So we'll have to see how the next quarter looks as far as the manufacturing. Now, when it comes to inventories, this is a very strong signal when it comes to availability of supply chains and normalization of supply chain and pricing. So now you can see that the inverted consumer inventories are spiking up. So historically, whenever these inventories come off, this is the consumer inventories, whatever is in store already. Whenever they come off, the PMI goes up, right? So whenever supply is tightened, as long as it is tightened because of demand, then the PMI goes up because new orders come in to replenish that inventory and then production follows. So right now we've been in a downtrend for inventory since 2022, but this is not led by demand. It's led by lack of demand, right? So why build more inventory when there's no demand? This is why inventories have been going down to squeeze out the very little stock that is left. Now we're seeing a spike. So historically, this would be bearish, but I believe this spike is coming from new demand in the real economy and businesses getting ready to fulfill on that demand. So they're starting to spike their inventories. Now, when we zoom out and we check the real economic activity, it seems like it's rolling over. So when we look at the trade balance for manufacturing, anything outside of AI seems to be contracting. So in the third quarter of 2024 up until the third quarter of 25, so we have a whole year of the real economy starting to recover. This is where we saw names like Dollar Tree, like potential consumer staples, right? Like Costco, Walmart. They all started to recover a little bit, and then tariffs came in 2025. And this is when trade really started plummeting. So in the fourth quarter of 25, starting from that second quarter, steep decline, right? So in the second quarter, we have an 8% spread between imports and exports. And now we have quite the opposite, right? So negative 34% spread, meaning we're not really trading. And I don't know whether this is because of the economic slowdown or because the tariffs are having an effect on the broader global trade. Nonetheless, this could be a signal for the real economy trade, potentially bottoming, potentially saying we're too early to tell. But remember, the markets are forward looking. So negative 34% is quite a big amount historically. So it could mark the beginning of mean reversion. And this is why maybe the market is starting to rotate back into the real economy. Within the manufacturing sector, we have four industries signaling a breakout in demand. So again, the potential turnaround for the real economy, I think, is happening within these four industries. So ever since March 2025, essentially when the Liberation Day took place for the tariffs, we now have primary metals, apparel, computer electronics, and machinery, right? So 3 out of 4, I think, are related to the AI trade. So of course, primary metals, you have things like steel, iron, aluminum, and then apparel, I think it's a new trade. This is very interesting because of the tariff cancellation, right? So you have Congress going back on the tariffs set by Trump, which is why now I start to see more demand and more activity coming into apparel because pricing might become more certain now. when you remove the tariff costs and the inflation starts to sort of get back into line after the Iran war ends, right? So there's two catalysts for this. First is, of course, the removal of tariffs, and then the Hormuz Strait opening. Now, when it comes to computer electronics, this is more to do with memory. So new orders are going up for memory and everything like that because of Micron and SK Hynix and Samsung spiking prices. So maybe they're trying to get the new orders now at the current prices before they keep going up. Let's see how that develops, right? But something to watch out for the companies in the middle of these new orders. And then we come down to machinery. So machinery could be anything from transportation. Now that oil prices have normalized, we're going to see more activity in trucking and airlines and shipping. So it could be based on that. It also could be based for data center construction, right? So machinery for the industrial applications of these data centers and their build out process. Nonetheless, these are the four industries that I want to watch out for within manufacturing and have already filtered for stock selection. Now we see the mapping here, right, out of these four industries, which go from new orders being placed down to production happening to fulfill those orders, and then inventory changes, right? So the dynamic between these three segments tells you everything you need to know about the industry. So let's say primary metals, let's start there. It is in the top 5 readings for new orders. Of course, that leads to booming production, and inventories are rising. So what happens here is supply is starting to keep pace with demand, right? Otherwise, you'd see inventories declining out of unexpected demand or unpreparedness in the supply chain. So with primary metals, think of steel producers like Cleveland Cliffs, maybe. Think of aluminum, think of iron, right? So if everyone knows and understands and expects that the AI build out is going to require a lot of these metals, that's why the orders are coming in. That's also why the production is booming. And that's also why inventories are rising at par. So I don't expect any bottlenecks here. I don't expect anything of too crazy of nature to happen in metals, but I do expect a quarter or two of expanded earnings, which is why that uncertainty is leading me to a long short equity trade to profit off of both scenarios, whether we do have a bottleneck or we do end up having a normalized supply chain. Now for computer electronics, again, top 5 new orders, booming production, and rising inventory. So this is where you have to be careful, right? If you read our take on Micron's earnings, you understand that the entire quarter was led by price spikes in memory, not necessarily by sales volume. And now you have companies like Microsoft, they're spinning off the Xbox and gaming department because of rising memory costs. And then you have Apple increasing their prices on hardware because of memory. So all of that, I think, is going to have an effect on the supply chain. It's going to be a harder trade to construct and look for, but definitely something to watch out as computer electronics see their prices increase. I think Best Buy and GoPro could be one of those lottery tickets here. Now, machinery. Again, top 5 producers, booming production, and rising inventory. So again, anything that has to do with machinery in the data center and AI build out, I think is going to benefit, but with the same caveats of potentially normalizing supply chains and relying on pricing rather than volume, just because of the inventory rising. So the one clear trade and one of the freshest signals here is in apparel. So we have an outlier breakout. It was in the top 5 of new orders, but the other industries had been expanding for a while, and apparel is just now beginning to expand after a contraction. So again, 1 month. I'd like to see at least 2 months of this continuation, but 1 month of that significant of a breakout is enough for me to start looking into it. Production is up, so it is booming, and then inventories are down. So this is the tell that I like to see. Why? Because new orders are up, production is up, but the supply chain was not ready for this, which is why inventories are falling, because sudden demand came into the picture, and now they're left with tight bottlenecks and tight stock. So when you look at names like On Holding, and ALO and other private companies, they're the only ones pushing in growth in revenue for North America. Then you have Lululemon and Nike declining in revenue. So this is more about branding than pricing, because On Holding is pretty similar pricing to Lululemon. So I would say this is more about branding than pricing again. And we're going to get into those trades later in the week. Make sure you sign up to the newsletter because we're going to cover those first in there. Now, the commentary, right? The commentary is one of the sections in the PMI that people like to skip just because it's a lot of text and you have to really think about what's going on in there. So computer electronics, the executives there gave you sort of their thinking behind what's going on. They're saying that prices are becoming an issue. Of course, this is due to the memory spikes and everything I mentioned about Apple, Microsoft. Interest rates are a headwind to future orders, so this is something we should watch out for. As inflation, as interest rates uncertainty kick in, capex and future orders for all this machinery, for lithography, for memory could be affected. So we have to get, of course, inflation under control if you want to see further expansion in the memory trade. So again, Apple, Microsoft, two to watch out for what they do about hardware pricing. Then you have machinery. So orders are being led by semiconductor and defense, right? So machinery, nothing to do with anything in the real economy. It's everything to do with data centers, defense, and semiconductor related machinery. So again, a very strong tell when it comes to what we're seeing in the data and what we just saw in the commentary. So again, it's a good area to start looking for short-term to medium-term trades. And now we go to the price signal in memory. So the Micron just had a blowout earnings report. We all know that. We've all seen it in Twitter and social media. But like I broke down inside the newsletter, there's a reason why the stock is down by 20% since that earnings report. And it's because the entire quarter was led by price dynamics and not volume. You saw an 86% boost in revenue, while the inventories did not move at all. So that tells you if prices normalize, if the supply chain normalizes for memory, then what happens to Micron? I think that revenues could come off by 50%, earnings by a whole lot more, and the stock could go down even further. You only need to look at Oracle for an example like that. But now Goldman Sachs and the trading desk says that this is one of the most shorted names inside communications for the US market, which again tells you a lot about how people are feeling about the current valuation of Micron. So something to watch out for. We are getting positive data out of the computer and electronics industry. But again, this is Micron specific, not industry specific. So on one side, the industry seems to be doing well, but is also overbuilding, and you have Micron being exposed by not a lot of volume, but rather sales spikes or pricing spikes. So if that positive read in the PMI ends up becoming oversupply, then Micron could go down by a whole lot more. And then you have the whole Korean crisis, which I posted about as well. So feel free to read that. Now we're switching over to services. We're hunting for the same thing, right? We want to see expanded demand. And the only industries really that have been in that uptrend have been retail trade. So again, that kind of matches the apparel breakout that I see, the supply chain normalization, even though we are at all-time low readings for consumer confidence, inflation uncertainty, and supply chain uncertainty from the Iran war, retail is still doing well. But it is doing well in select premium names, which is where I have built my entire trade around. Now, then you have transportation. This is, I think, due to the post-Hormuz opening, with fuel prices and costs normalizing, you're going to see benefits all across shipping, trucking, and airlines as well. So a pretty good trade to start building up there. And then finance and insurance. So you have picks like I mentioned in Robinhood. We'll get into more of the reasons why later, but there's a lot of tailwinds happening for the industry, and I think Robinhood is one of the clear winners here. Now, both PMIs have converged into one theme, and manufacturing obviously goes to primary metals as a top new order pick and a production outlier, while services goes to construction, right? So construction in the data center, construction in the AI infrastructure place, and then you have manufacturing, signal, and primary metals. Which metals are used in the data center in the AI build out? Of course, steel. And apart from steel, you have iron and everything else. So this is where I'd like to prepare a long short trade idea, just because we don't know what's going to happen to capex. We don't know what's going to happen to further build out of data centers. So of course we have to be prepared for both scenarios, and this is where the strategy of long short equity comes in. Now moving forward into the services picks, we have of course retail trade, like I mentioned, transportation and warehousing, finance, and information is right up there. It missed by a hair, right? But if information starts breaking out, which I suspect it will based on the NFP we got last week, then of course the rotation back into software starts to become a lot more attractive here. Now, Hormuz trade recovery. This is where shipping comes in. This is where transportation, warehousing, breakouts of these services PMI gets to be explained. So, of course, this is going to benefit airlines, trucking, and shipping as a lower fuel costs come in. That increases margins, increases demand, makes shipping and transportation more affordable, right? So there's one trade that I spotted here. I'm not necessarily going to take this unless the due diligence checks it out, but it's in KNX, Night Swift Transportation. This is an options trade that I spotted. The stock is currently trading around $75 a share. Traders are expecting 85 by this month, July, and then 105 by December. So pretty good tail risk in terms of upside. So I'll do my due diligence here and I'll relay any findings in further videos. But you're going to get it first inside the newsletter, so make sure you sign up. And then for finance, what's good for gamblers is going to be good for the brokers. And right now we have 3 potential tailwinds for brokers like Hood. So we have the PDT rule removed, so you no longer need 25 grand in your account to day trade unlimitedly. So again, a lot of people are going to be trading options, futures, and a lot of other products that they couldn't have access to for day trading. So of course this is fees for Robinhood. This represents dark pool data being sold as far as what retailers are doing. So of course a lot of fees are going to come in. The frenzy around the AI trade, of course, creates a lot more fees as well as active traders come in and bet on the AI frenzy and the memory trade and everything else. And then earnings upside. I think it's going to be the catalyst for Hood, right? As you see the finance industry, the finance and insurance industry break out in services for 3 consecutive months, and Robinhood being right in the middle of that storm, I think chances are that this stock is going to go up much higher from where it is today. And if you follow me on Twitter and the newsletter, you would have seen this stock pick being pitched out to you in the low 70s. So we're well into 30 to 40% upside so far into this trade. Now, like I said, both surveys converge in one industry map. So we have primary metals being confirmed by construction in the services, and we have computer electronics again confirmed by construction and the memory trade. Then you have machinery for semis and defense, again confirmed by construction. And then you have apparel, again 1 month breakout. Well, this could be a trend nonetheless, so we watch out for it, which is confirmed by the retail trade breakout in services. So it is an attachment to the apparel breakout in manufacturing. And then of course transportation, warehousing out of Hormuz, and finance and insurance based on the catalyst I mentioned, being the yield curve expansion, the PDT removal, and all of that good stuff, and the frenzy that's going on. So here are the trade signals that I'm watching and that I'll be breaking down inside the newsletter. So we have ONON, which is on holding, part of the apparel trade, as well as Lululemon, LULU. So both are in the apparel trade watch that I have. For on, we have a call option trade that I'll be putting on and pitching out to you. This is a shorter term to medium term in nature, I'm doing the research right now, and it looks like a pretty good candidate. I'll relay any findings in the newsletter. And then Lululemon is more of a value play here. It's more of a turnaround target for the portfolio. So this is going to be an equity play, while on holding is more likely going to be an options play. Now, if Lululemon doesn't turn around in time, I expect the opportunity cost of time to be paid off by the options trade in on holding. Then we have finance and insurance. This is not going to be a trade since I already took it in the low 70s. I'm already up pretty good amounts on Robinhood, but it's something to watch out for in case we do get a renewed upside target based on further earnings. For transportation, like I mentioned before, there's a trade going for 85 in July and 105 in December. I'm doing the research right now for KNX. It's looking pretty good. So I'll relay anything that I find in the newsletter. And then primary metals, we have a long short equity trade. It's looking like it's going to be long Cleveland Cliffs, CLF, and then short Nucor and UE. So watch out for that. If I find it to be a great trade setup, then I'll relay it in the newsletter. And then, of course, we have the caution and potential shorts found in Micron and other memory names. Now, this is going to be a dangerous one because there's a lot of people writing behind this. Retail likes it a lot, so the volatility could be expanded well beyond what I'm comfortable with. But again, something to watch out for. Signpost to watch moving forward. We have the top 5 inventory rising names. So again, if industries that I mentioned continue to post higher inventories, then it is something you should keep in mind as far as the oversupply potential in semiconductors and memory and everything else. Memory prices, as a result, should be on your radar because if memory prices normalize, again, Micron, SK Hynix, and Samsung are going to be very, very highly exposed, which leads me to the Korea margin calls. If memory prices normalize, I think the Kospi in South Korea goes down with it, and the collateral being 600 billion roughly in U.S. equities gets taken down with it as well. Consumer confidence for the apparel and retail trade, we are still at all-time lows. Premium names are going to win, the middle dies, and the bottom turns. I think Lulu is within the bottom, and On Holding and other names I've screened for are in the premium names. So again, we're betting on a turnaround from the bottom in Lulu, and we're betting on a continuation in leadership at the top from On Holding. Construction lead times, again, if data center buildouts take longer than they are today, you might see sort of contracting activity, contracting demand as lead times can't be fulfilled and prices begin to get affected. So I'd watch out for that in the construction industry. And then earnings season, we have roughly 2 weeks until earnings season kicks off. So this is going to be a lot of catalyst, a lot of price action attractiveness really for all these trades that I mentioned, and another gauge on what's happening in the capex outlooks, in financing, and the chip and memory trade. I know this was kind of all over the place, a lot of information, but again, you feel free to read it in the newsletter version. Everything is written out in a simpler form and more concentrated format. Again, feel free to sign up. Link is below. I'll link the written version of this as well, and my deep dives on the Lululemon and other apparel trades that are coming out this week as well. That's part of the premium version. Keep in mind, prices are going up from $59.99 a month to $249.99 a month starting in July 17th. This is due to demand and due to the fact that we're providing so much alpha to members that it just doesn't make sense to keep prices that low for everyone. So again, I hope you enjoyed this one and got a lot of value out of it. I'll catch you in the next one, and stay tuned for the newsletter. It's coming right to your inbox.